Hello and welcome to episode 6 in our ongoing series on successful trading. In this episode we're going to look at risk management and then what I refer to as the arithmetic of trading. We'll start with risk management. This is simply the most important part of the business. You may have heard that before, you may have read it before, there's a reason, it's true. You can fiddle around endlessly with all the other components of your trading plan, but it all amounts to nothing if you don't get your risk management right. Now, we know we're going to get losing trades. Not only will we get losers, we'll get groups of them. When we do, as we've mentioned before, the value of our portfolio drops. We call this drawdown. The primary objective of trading is to manage the impact of such a group of trades and by so doing, manage the associated drawdown. The beauty of a properly constituted trading plan is that you decide how much drawdown you are prepared to accept, unlike the average investor who is at the whim of the market. There are two primary components involved in doing this. Firstly, we can limit the amount we lose in any one trade. Secondly, we limit our exposure to any one stock. When we first take a trade, we set an initial or fixed stop loss. This acts like a safety net under the trade. If the price falls to this level, we will simply close the trade and move on. In so doing, we are in charge. We decide the outcome. Here's an example of this in action. Entry is on June 1 at $5.40. The fixed stop loss is then set at $4.52. If the price drops to this level, we simply get out. The first thing to note is that we haven't set the exit point too close to the action. You have to give a stock room to breathe. This is called the stop size. By setting up like this, we are controlling how much we lose. We're managing the risk in the trade. In this case, the stop loss is set at a size of 88 cents. So if, for example, we buy 227 shares, we limit our loss, should the trade go against us, to under $200. Key point is, we limit the loss. Now, of course, we don't always get out where we would like. Shares do gap occasionally. By the same token, not all trades go completely against us. Some will head up first before falling back. These will not cost us everything we were prepared to risk. And from our back testing, we can see the average of our losers and ensure that this average is less than our maximum loss. But what happens when the share price drops or gaps 50%, let's say, in value overnight? Well, first off, an occurrence of such an event, particularly as a result of following the methodology we teach at HomeTrader, is very rare indeed. In fact, we have to look back as far as 1999. In this instance, it was Bryant. It closed at $9.10, opened the next day at $5, then dropped immediately to $3 before recovering to close at $4.35. This is the definitive example of why we don't put all our eggs in one basket. To contain the damage in an event like this, it's essential that we don't have too much exposure in any one place. We do this by limiting our position size. Let's say you're a trader with a total capital of $10,000. By having a limit of 20% in any one trade, you have a maximum exposure of $2,000. A worst case scenario doesn't mean that it's all over. You survive to take the next trade. Let's turn back now and have a further look at the benefits of containing our losses. I call this the arithmetic of trading. Let's imagine we have that same fund of $10,000. Let's also assume that we will limit our loss in any single trade to 2% of that fund, or $200. For the sake of the exercise, we will assume that our universe of trades is 40% winners, 60% losers. So out of every 10 trades, we'd expect 4 winners and 6 losers. Despite knowing that some of our losers will have gone up first, we're going to assume that all our losers cost the whole amount. On the other side of the equation, we'll work on an average win of $600. An average win to an average loss ratio of 3 to 1. The reason for this is that we let our profits run. We will look at this in more detail in the next episode, but for the moment, I'm using my benchmark of 3 to 1 in a base level, medium-term system trading just alongside of the market without any leverage. This ratio will of course vary with different trading styles, but it'll give you the overall idea. On the right hand side, the 6 losers cost us a total of $1,200. On the left, the 4 winners make us $2,400. The difference is a profit of $1,200. This exercise raises a number of points. Firstly, it shows the benefits of being able to take a small loss and let profits run, rather than succumbing to fear and jumping out too early. Secondly, it shows that we can be profitable with a win rate at just 40%. In other words, it's not just about picking winners. You don't have to be right all the time. Thirdly, we can see that trading done properly creates a positive expectancy environment. This is opposed to walking into a casino where the house and the government take their slice, leaving the punter in a negative expectancy environment, one in which you expect to lose. So you can see that through the process of controlling our losses and allowing our winners to run, we stack the odds in our favour. This is the essence of what it means to be a systematic rather than impulsive trader. It makes the difference between success and failure. In the next episode, we'll look at how to lock in profit.